Hello, I'm SA, your AI essayist. Please note that all content, audio and video in this presentation are AI generated. As AI can sometimes produce inaccuracies, I encourage you to verify any factual information presented. With that in mind, let's begin. A single undergraduate thesis, completed at Princeton University in 1951, represents one of the great intellectual pivot points in the history of modern finance. Its title, The Economic Role of the Investment Company, sounds deceptively dry, the kind of academic exercise destined for a dusty library shelf. Yet within its 130 pages, its author, a young John Clifton Bogle, assembled an argument of such simple, devastating arithmetic that it would eventually threaten the foundations of the entire active investment management industry. This was a document born into a world of profound confidence, a world that celebrated the acumen of the professional stock picker and accepted, as an article of faith, that expertise could consistently conquer the whims of the market. Bogle's contribution was to hold a mirror to this world, a mirror polished with empirical data, and to ask a question so elementary, so obvious in retrospect, that it amounted to heresy. The financial ecosystem Bogle surveyed was built upon a compelling narrative of value. Investment companies, the precursors to the modern mutual fund, positioned themselves as vessels of superior knowledge, steered by brilliant captains of capital. For a fee, an ordinary investor could gain access to this professional oversight. The industry's appeal rested on the promise of alpha, the technical term for returns achieved above and beyond a market benchmark. This pursuit of outperformance was the industry's entire reason for being, justifying a formidable structure of costs. Investors typically paid a substantial front-end load, a sales commission that could consume up to 8% of their initial capital before a single dollar was even invested. Annually, they paid a management fee for the portfolio manager's expertise, alongside other operating expenses. The entire edifice was predicated on the belief that the value added by the manager's skill would handily exceed the value subtracted by these considerable costs. It was a consensus so complete, a piece of accepted wisdom so pervasive, that challenging it was akin to questioning the utility of a physician in a hospital. Bogle's thesis performed a radical act. It subjected this grand narrative to the cold, impartial scrutiny of long-form arithmetic. He undertook a meticulous empirical study, gathering the available data on the performance of investment companies. His approach was that of a careful scientist isolating variables. He analyzed their stated objectives, their portfolio compositions, and most critically, their results. He found that the industry's claims of superior performance withered under examination. When the full effect of all frictional costs was accounted for, the supposed expertise of the professional manager seemed to vanish. These costs created a relentless mathematical drag on returns. The portfolio manager's active trading, intended to capture fleeting opportunities, generated its own layer of expense through brokerage commissions and bid-ask spreads, further eroding the investor's potential gains. The central insight that emerged from Bogle's analysis possesses the beautiful, unyielding force of a physical law. He articulated what would later be called the cost matters hypothesis. Before the deduction of any costs, the aggregate of all investors in the market, by definition, constitutes the market itself. Their collective activity creates the market's return. Therefore, as a group, these investors will earn precisely the market return. Once the costs of financial intermediation are introduced, the management fees, the trading commissions, the administrative expenses, the aggregate return, for this same group of investors must mathematically fall below the market's return. The average actively managed dollar, after accounting for its expenses, will perpetually trail the average passively held dollar. The very act of seeking out performance, with all its attendant activity and expense, became the primary reason for a collective failure to achieve it. This was the paradox hiding in plain sight, an inefficiency born from the very search for efficiency. From this stark mathematical reality, Bogle drew a conclusion that struck at the heart of the industry's self-perception. He wrote with the clarity of a young scholar who has followed his evidence to its logical terminus, that investment funds may make no claim to superiority over the market averages. This simple sentence was revolutionary. It reframed the active fund manager from a financial oracle into a source of negative value, a purveyor of costs that, for the average client, overwhelmed any potential benefit. The manager's quest for market-beating stocks became a loser's game, a contest where the primary victor was the house, which collected its fees regardless of the outcome for the players. The heroic narrative of the stock-picking genius was replaced by a far less flattering portrait of an expensive and ultimately futile endeavor. Within this critique lay the blueprint for a profoundly different approach. If the effort to outperform the market was the source of underperformance, the most logical course of action was to abandon the effort altogether. The thesis implicitly sketches the form of a new kind of investment vehicle, one that would make no pretense of genius. This hypothetical fund would seek to own the entire market, perhaps by replicating a broad stock index like the Standard & Poor's 500. Its goal would be to capture the market's return, minus the barest minimum of unavoidable costs. By eliminating the expense of active management and minimizing portfolio turnover, such a fund could deliver a result that was almost certain to outperform the majority of its actively managed peers over the long term. It was a vision of elegant simplicity, a proposal to win by refusing to play the conventional game. This academic framework, formulated in the quiet halls of a university, contained the intellectual DNA for a complete disruption of the financial services industry. The core mathematical principles Bogle identified in 1951 are as potent today as they were then: the tyranny of compounding costs and the zero-sum nature of the market before fees remain immutable. An idea of such disruptive potential, however, rarely remains confined to the pages of a library. The journey from this powerful theoretical insight to a tangible functioning entity would require decades of experience, a bitter corporate schism, and an act of commercial audacity that many industry veterans would greet with outright derision. The intellectual foundation was laid. The challenge of building upon it would define the next chapter of his career. His professional journey began within the very edifice his thesis had critiqued. Upon graduation, John Bogle secured a position at the Wellington Management Company, a respected conservative firm specializing in balanced funds. Here, the abstract principles of his academic work collided with the complex, human-driven machinery of institutional investment. He rose with remarkable speed, his ambition and intellectual acuity propelling him through the firm's ranks. Wellington became his laboratory, a place to observe firsthand the behaviors and structural incentives that governed the flow of capital. He absorbed the industry's culture, its language of salesmanship, and its deep-seated belief in the superior wisdom of its professional managers. His ascent culminated in his designation as heir apparent to the firm's founder, Walter L. Morgan. The prevailing winds of the 1960s, however, were anything but conservative. The go-go years fostered an environment of speculative fervor, where aggressive growth funds promising spectacular returns captured the public imagination and, more importantly, its capital. Wellington, with its staid, balanced approach, appeared increasingly anachronistic. Under immense pressure to compete, Bogle made a fateful decision, championing a merger with a group of young, aggressive portfolio managers. This move was intended to inject a dose of modern dynamism into the firm. Instead, it introduced a profound clash of cultures, and when the bull market of the 60s gave way to the brutal bear market of 1973 to 1974, The merged entity suffered devastating losses. The ensuing boardroom battle was swift and decisive. In 1974, the board he had once led voted to fire him. This professional cataclysm proved to be the essential catalyst for his most radical contribution. Stripped of his role, Bogle was afforded a unique vantage point from which to diagnose the industry's fundamental pathology. The problem, he concluded, was structural, an inherent and irreconcilable conflict of interest baked into the very architecture of the mutual fund business. This is the classic principal-agent problem, articulated in the language of economics. The fund shareholders, the principals, entrust their capital to the management company, the agent, with the objective of maximizing their investment returns after all costs. The agent, however, is a for-profit enterprise. Its own objective is to maximize its revenue, which is derived primarily from fees levied as a percentage of the assets it manages. These two objectives are perpetually at odds. For the investor, lower costs are always better. For the management company, higher fees and a larger asset base generate greater profits. This misalignment incentivizes behaviors that favor the agent over the principal, elaborate marketing campaigns to gather assets, the creation of complex and fashionable funds that command higher fees, and a general resistance to lowering expenses. The entire system was engineered to enrich the managers, with the success of the investors being a secondary and often elusive outcome. The elegant mathematical certainty of his senior thesis, that costs inexorably devour returns, was playing out in a sprawling industry-wide drama of misaligned incentives. His solution was an act of profound structural reimagination. He proposed the creation of a new company, which he would name Vanguard, after Lord Nelson's flagship at the Battle of the Nile. This new entity would possess a corporate charter unlike any other. Vanguard would be organized as a mutual company. It would be owned by the funds it administered. Those funds, in turn, are owned by their shareholders. With this single stroke of corporate engineering, the principal-agent conflict was dissolved. Vanguard, the management company, would have a single mandate to serve its owners, the fund shareholders at cost. There would be no external stockholders to please, no profit motive to satisfy. Its purpose was to minimize expenses, effectively transforming the management function from a profit center into a low-cost administrative service. It was a declaration that the interests of the investor would be paramount, a concept so elementary in its fairness and so radical in its commercial implications that it amounted to a heresy within the established financial order. With this revolutionary structure in place, Bogle prepared to launch its first unique product, the physical embodiment of his decades-old academic insight. In 1976, Vanguard introduced the first index investment trust. Its strategy was audacious in its simplicity. It would make no attempt to outperform the market. It would employ no star managers, conduct no proprietary research, and make no forecasts. Its sole ambition was to mechanically replicate the performance of the Standard & Poor's 500 Composite Stock Price Index, a broad benchmark of the American stock market. The fund would buy and hold the constituent companies of the S&P 500 in their approximate market cap weights, thereby guaranteeing it would deliver the market's gross return, minus the friction of its minimal operating costs. The industry's reaction was a symphony of scorn and disbelief. The concept was derided as a formula for guaranteed mediocrity. One prominent brokerage firm released a now-famous poster that depicted the fund as a sinking ship, declaring indexing to be un-American. The very idea of aspiring to be average was anathema to a culture built on the myth of superior stock-picking prowess. The initial public offering was a commercial disappointment. The underwriters had hoped to raise $150 million. They managed to secure a mere $11 million. The fund was so small it was unable to purchase every stock in the index, settling instead for a representative sample of the largest 200. The entire enterprise was mockingly christened Bogle's Folly. This was a venture, critics crowed, that was doomed from its inception, a quaint academic experiment with no future in the real world of finance. What they perceived as a folly, however, was a meticulously designed vessel, built to harness the most powerful and persistent forces in finance: the law of large numbers, the zero-sum game of the market before costs, and the relentless corrosive power of compound arithmetic. The engine powering this vessel, this supposed folly, was a set of principles so elementary they appeared almost heretical to the financial priesthood. With the Vanguard experiment launched, John Bogle embarked on a second parallel career, that of a prolific author and public intellectual. He understood that a revolutionary financial product was insufficient on its own. It required a philosophical and mathematical scaffolding, a clear articulation of the ideas that gave it form and purpose. The challenge had evolved. With indexing gaining a fragile foothold, the established industry responded with a wave of complexity, marketing ever more elaborate, and costly strategies. The core truth of Bogle's insight risked being drowned in a cacophony of speculative noise. His response was to codify his beliefs, to translate the intricate dynamics of the market into a clear, evidence-based catechism for the individual investor. This work culminated in his 1999 masterwork, Common Sense on Mutual Funds, a text that weaponized simplicity against a world of obfuscation. At the very heart of his argument lies a concept Bogle termed the cost matters hypothesis. It is a proposition whose profound implications arise from its sheer, unassailable logic. He articulated a fundamental equation of investing reality. An investor's net return is the direct consequence of the market's gross return diminished by the costs incurred. The formula itself, gross return minus cost equals net return, operates with the force of a physical law. Before costs, the collective of all investors earns the market's return. It is a zero-sum game relative to the average. For every investor who outperforms the market, another must underperform by a precisely equal amount. This is a closed system, a tautology, as certain as 1 + 1 = 2. The moment costs are introduced, advisory fees, expense ratios, trading commissions, tax inefficiencies, the elegant symmetry is broken. The game becomes negative sum. The collective of investors as a group is guaranteed to underperform the market by the exact amount of the costs they pay. The financial industry in this formulation appears as a formidable croupier, raking a percentage off every bet, ensuring the house always wins in aggregate. This led to his second great intellectual pillar, what he called the relentless rules of humble arithmetic. This was the cost matters hypothesis, extended over time, revealing the devastating power of compounding working in reverse. Bogle delighted in laying out the stark mathematics. Consider two investors, each starting with the same amount and earning the same hypothetical gross annual market return of 7% over a 50-year period. One invests in a low-cost index fund with an annual expense of perhaps 0.2%. The other chooses a typical actively managed fund with an annual expense ratio of 2%. The difference appears trivial, a mere rounding error to the casual observer. Yet the humble arithmetic tells a different story. The first investor's capital compounds at a rate of 6.8%. The second investor's capital compounds at a rate of 5%. Over half a century, this small annual friction of 1.8 percentage points creates a chasm. The low-cost investor's final wealth will be almost double that of the high-cost investor. The fees, Bogle demonstrated, consume a staggering portion of the potential return, a silent transfer of wealth from the client's pocket to the manager's. He would call this the tyranny of compounding costs, a force as inexorable and powerful as gravity. This simple arithmetic exposed the futility of seeking a manager who could consistently outperform the market by a margin sufficient to overcome this cost hurdle. The search for such a rare genius, he argued, was a loser's game. Flowing from this mathematical certainty was a crucial philosophical distinction. Bogle drew between the concepts of investing and speculation. For Bogle, investing was the act of acquiring a stake in a business enterprise, participating in its long-term productive growth, the earnings it generates, and the dividends it distributes. It is an owner's mindset rooted in the real economy of goods and services. The return from investing, in his view, comes from the intrinsic value created by corporations over time. This owner's perspective stood apart from speculation, which he characterized as the activity of wagering on short-term price fluctuations. The speculator's return depends entirely on correctly predicting the psychology of other market participants, on selling a security to someone else for a higher price than they paid. Bogle saw the modern financial market as a place where speculation had overwhelmed investing. The immense daily trading volume, the obsessive focus on quarterly earnings reports, and the breathless media commentary all pointed to a system more interested in pricing than in value. He viewed this as a grand distraction. The real, durable source of wealth was the slow, patient compounding of value in the real economy, a process best captured by owning a broadly diversified portfolio of businesses, the entire market, and holding it essentially forever. These principles, articulated with relentless clarity and supported by mountains of data, form the bedrock of a burgeoning grassroots movement. Individuals who read Bogle's books and essays began to see the market through his eyes. They recognized the mathematical truths and the philosophical coherence of his approach. They formed communities online and in person to share knowledge and reinforce their commitment to this disciplined, low-cost strategy. They became known as Bogleheads, a testament to the personal impact of his intellectual crusade. His writings became their foundational texts, a source of guidance and fortitude in a financial world that constantly tempted them with promises of easy riches and complex, exciting products. Bogle had armed the average person with a powerful intellectual toolkit, allowing them to navigate the complexities of finance with confidence and a deep understanding of the underlying forces at play. He had transformed a seemingly arcane subject into a matter of common sense, built upon the relentless and humble rules of arithmetic. His philosophy was an elegant proof that in the world of investing, the most sophisticated strategy was often the simplest one. The triumph of this elegant arithmetic, however, contained the seeds of its own paradoxical complication. The very success of the index fund, its undeniable mathematical logic, and its widespread adoption gave rise to a new generation of financial instruments that mirrored its structure while subverting its spirit. The quiet, disciplined accumulation of the entire market, a strategy predicated on patience and the acceptance of average returns, was soon challenged by a faster, more agile, and far more tempting variant: the exchange-traded fund, or ETF. Many of these new instruments were, in their composition, index funds. They tracked the S&P 500, or the total stock market, with the same low internal expenses that Bogle had championed. Yet they possessed a crucial difference in their mechanics. Unlike a traditional mutual fund, which is priced once at the end of the trading day, an ETF could be bought and sold continuously, its price fluctuating second by second, like any individual stock. This innovation introduced a velocity that was entirely alien to Bogle's philosophy. The architecture designed to encourage long-term holding was suddenly adapted to facilitate high-speed speculation. The plowshare of patient investing had been reforged into the speculative sword of the day trader. With this development, Bogle entered the final, and perhaps most revealing, phase of his career. He became the chief critic of the industry he had largely created, a conscience for a world that increasingly bore his structural imprint but lacked his philosophical conviction. From his modest office in Malvern, Pennsylvania, he launched a relentless intellectual campaign. He saw the proliferation of ETFs, particularly those focused on narrow, esoteric market sectors, funds for robotics, for cybersecurity, for cannabis stocks, as a betrayal of the core principle of broad diversification. He argued, with the familiar force of his impeccable logic, that these were vehicles for performance chasing, luring investors into the latest hot trend at precisely the moment it was likely peaking. The costs matter hypothesis was extended. The cost was longer, a matter of expense ratios alone, but also the immense friction of portfolio turnover and the behavioral errors encouraged by rapid trading. His critique was a masterclass in applying first principles to new phenomena. He would patiently explain that while an ETF tracking the total market was a perfectly sound instrument for a long-term investor, its intraday tradability was a feature that served the interests of Wall Street's intermediaries far more than the end investor. Every trade generated a commission. Every flurry of activity widened the bid-ask spread, reintroducing the very croupier's take that his original fund was designed to eliminate. He saw it as a profound irony. The market had taken his low-cost chassis and bolted a high-octane speculative engine onto it, marketing the result as progress. This public critique expanded into a deeper, more structural concern about the consequences of his own success. As Vanguard and its competitors grew into colossal asset managers, collectively owning a significant percentage of the entire American corporate landscape, a new problem of governance emerged. If these giant passive institutions owned 10, 15, or even 20% of a company's shares, who was exercising the responsibilities of ownership? The traditional theory of shareholder capitalism relied upon active, engaged owners to hold corporate management accountable. Bogle foresaw a future where the largest shareholders were, by their very nature, passive portfolio managers, creating a vacuum of oversight. He termed this the stewardship problem. He argued with increasing urgency that passive investing could only mean passivity in portfolio selection. It could never mean passivity in corporate governance. He admonished the leaders of Vanguard and other large index providers, insisting they had a profound fiduciary duty to become the most engaged, thoughtful, and long-term oriented owners in the world. They had the power, and therefore the obligation, to vote their proxies with diligence, to challenge excessive executive compensation, to push for sound long-term corporate strategy, and to hold boards accountable for their actions. He viewed the concentration of capital that indexing had produced as a monumental responsibility. The mathematical efficiency of the index fund had to be matched by an ethical commitment to the health of the underlying corporations and, by extension, the entire capitalist system. In his final years, his voice became a powerful counter-narrative to the prevailing triumphalism of the indexing revolution. He was the ghost of capitalism future, warning that the solution to one set of problems had created a new, perhaps even more profound, set of challenges. His work, which began as a simple proposition about market efficiency and cost, had evolved into a deep inquiry into the duties of ownership and the moral purpose of capital. To assess the legacy of John Bogle is to look beyond the trillions of dollars that now reside in index funds. It is to recognize a fundamental re-architecting of the relationship between the individual and the financial markets. He built a system founded on democratic principles, equal access, transparency, and the simple, unassailable truth of arithmetic. His work was a grand exercise in applied mathematics, demonstrating that over the long run, the collective wisdom of the market, harnessed at minimal cost, would reliably outperform the vast majority of expert attempts to beat it. This was a contribution of immense practical and intellectual significance, a permanent feature of the modern economic landscape. Yet, his ultimate impact transcends this mechanical innovation. His life poses a foundational question that resonates with ever-increasing force in our time. Can the complex machinery of finance be engineered to serve the broad interests of society, to benefit the many participants over the few intermediaries? Bogle's entire career was a sustained, powerful, and functional affirmative. He demonstrated that it was possible. He built the proof. His final years, however, were a crucial addendum to this proof, a warning that even the most elegant and robust solutions require perpetual vigilance. They require a moral compass to prevent their capture and perversion by the very speculative impulses they were designed to quell. His legacy is therefore a dynamic one. It is a set of principles, a functioning model, and an ongoing, demanding struggle for the soul of capitalism itself. His life remains a powerful standing testament that the most profound revolutions can begin with a simple question of arithmetic and conclude with an enduring question of character. We really appreciate you tuning in to this AI-powered presentation. Our goal is to push the boundaries of AI in content creation, and your input is invaluable. If there's a particular subject you'd like to see us tackle next, or if you have suggestions on how we could fine-tune our AI's creative prompts, please don't hesitate to leave your ideas in the comments section. We're excited to bring you more unique content very soon.